Alright, let's talk about de-dollarization. Because what's happening right now? It's not just serious. It's historic. Things have gone from tense to tectonic ever since the G7 froze Russian assets. That moment, right there, set something in motion that can't be undone. We've said it before. Biden's decision to cooperate with Europe and immobilize those Russian funds might have scored points diplomatically, but financially? It cracked the foundation of global trust in U.S. financial leadership. And before anyone jumps to defend Trump, no, he didn't roll it back either. In fact, his tariffs made the situation even worse. They highlighted just how aggressive the U.S. has become with economic power. Weaponizing trade, consumer markets, financial infrastructure. It all sounds strategic until you realize what's at stake. Foreign investors currently hold $19 trillion in U.S. stocks. Add to that $7 trillion in government bonds and $5 trillion in credit assets. That's over $30 trillion. And U.S. treasuries alone? Foreigners own about 30% of the entire market. This isn't just big money. It's the lifeblood of America's cheap borrowing. And every day this trade war escalates, the pulse weakens. Trump keeps harping on the trade deficit like it's the enemy, but he's ignoring the flip side, the capital account surplus. That surplus has been the quiet hero, allowing the U.S. to borrow at next to nothing for decades. But that balance is shifting, and not just because of central banks backing away from treasuries. Something else is coming, a deeper shift, and it's happening right now. Brazil, yes, Brazil, is preparing to borrow using Panda bonds. That means issuing debt not in US dollars but in Chinese yuan. You have to understand how big this is. For years, the norm has been to borrow in US dollars. Why? Because the dollar is the global reserve. It opens up massive capital markets and gives lenders confidence. There's no exchange rate risk. Everyone wants to hold dollar-denominated assets. That means lower interest rates, cheaper borrowing. Lula could lock in loans at historically low rates if he sticks to the dollar. And normally that wouldn't be an issue. Brazil's a strong exporter. They ran a $74 billion trade surplus in 2024 alone, most of it in dollars. So they could borrow against those future surpluses, essentially mortgage tomorrow's earnings for cash today. But now, the game is changing. Trump's tariffs are ripping up that playbook. The more aggressive U.S. trade policy becomes, the more countries start to look for alternatives to the dollar. And it's already happening. Dollar bonds are getting expensive. Brazil recently issued a 10-year dollar bond at 6.73%. Compare that to the U.S. Treasury's 4.5%. If U.S. yields go up, Brazil might face 7%, even 8%. But yuan-denominated Panda bonds? They're looking at 2%. That's a third of the cost. Yes, there's currency risk, but here's the kicker. China controls the yuan's trading band. Meanwhile, the dollar is volatile, chaotic. It's falling today, but tomorrow? Who knows? Tariffs might get overturned. The dollar could spike. U.S. rates might rise further. And suddenly, dollar debt looks toxic. Now add in this detail. Brazil has a trade surplus with China. They sell more to Beijing than they import. That's worth about 313 billion yuan, or 44 billion. And as China cuts U.S. food imports, Brazil steps in to fill the gap. That surplus? It's only going to grow. So what does that mean? Brazil earns more yuan. And with more yuan, they can borrow more in yuan. And the more Panda bonds they issue, the weaker the dollar's position becomes. This is the feedback loop Washington isn't ready for. Trump's reshoring dreams sound patriotic, but the price? It's global trade, the reserve status of the dollar, and America's ability to finance its deficits cheaply. You can't have it all. You can't protect domestic industry, maintain reserve status, and enjoy low borrowing costs. Something must give. And then there's China. Besant wants China to rebalance their economy. He's said it for years. But be careful what you wish for. China is now staring at deflation. Prices are falling, not rising. CPI is forecast at just 0.3%. That gives Beijing a rare opportunity. They can unleash a massive stimulus without triggering inflation. If U.S.-China trade talks collapse, and that's becoming more likely every day, China won't wait around. They'll act. The PBOC will slash the reserve requirement ratio. Loans will surge. Liquidity will flood the system. Yields will drop even more. China will start buying up their own debt, and Panda bonds will surge. That demand? It'll pull capital away from the U.S. Treasury market. And here's the nightmare scenario. While China is stimulating, the U.S. is stuck. Why? Because America's problem is the opposite. It's spending too much, borrowing too much, and now facing higher yields. Investors are getting nervous about the deficit, about inflation, about the dollar itself. If China starts importing more, if global investors shift toward Chinese assets, U.S. debt will face serious competition. That's not speculation. That's market math. So what's left for Washington? Not demand. Demand won't recover, not in a tariff war. The only path is to cut supply. That means slashing government spending. That's the gamble behind Besant's beautiful bill. But it's not just about budgets. It's about defending the dollar's very role in the world. And as all this unfolds, a new headline breaks. Japan is buying Russian oil again. Sanctions? Still in place. But cracks are forming. Trump says he wants to end the war. The EU? They're doubling down. Von der Leyen is pushing for a deeper price cap, cutting it from $60 to $45. And even more aggressive, she wants Nord Stream 1 and 2 pipelines banned. Permanently. No Russian gas to Europe. Full stop. What's happening here isn't just geopolitical. It's financial warfare. It's monetary fragmentation. It's the unraveling of a world where the U.S. dollar was the undisputed king. And unless Washington wakes up, fast, we're going to find out what happens when the world stops playing by America's rules. They're dusting off the same old playbook, cripple Putin by cutting off his revenue. Simple, predictable, but also strangely timed. Why now? Why choose this moment of all times, when the global economy is already teetering, and a 20% tariff war with the United States is roaring back to life under Trump's trade agenda? It's a move that defies economic logic. The cause and effect are brutally obvious. Remove cheap Russian energy from the equation, especially now, and you ignite a chain reaction. Production costs surge. The price of goods soars, and with tariffs piled on top, exporting to the U.S. becomes a fantasy. The result? You strangle your own economy. And in the vacuum, another superpower steps in. China. With every new sanction, with every pipeline rerouted, China and the rest of Asia absorb what Europe throws away. Putin doesn't lose. He pivots. He shifts the flow of oil east, not west, and we've already seen this script unfold over the past 3 years. Europe should know better, but somehow it's as if memory resets every time the headlines shift. Now the cracks in the alliance are showing. A G7 ally, Japan, is no longer pretending. A Japanese refiner has just bought Russian oil for the first time in 2 years. That drought is over. Why? Because at the end of the day, the math doesn't lie. Price matters. Sanctions don't erase economic gravity. Energy is the foundation of any modern industrial economy. It powers machines, fuels logistics, and sustains national output. And countries like Japan, China, and Vietnam, they need mountains of it every single day. The moment you remove access to affordable energy, the entire structure begins to collapse. What Japan has done isn't defiance. It's survival. They bought 600,000 barrels of Russian crude on a tanker that's officially blacklisted. But this isn't reckless. It's calculated. Japan has something rare. A waiver from the Biden administration, granted during a more pragmatic phase in U.S. diplomacy. That waiver changes everything. It gives Japan the legal right to purchase Russian oil. Even sanctioned tankers are back on the table. And here's the punchline. If Europe really wants to enforce a total ban on Russian energy, they may now have to sanction one of their closest allies. That's the messy reality of sanctions. They're blunt instruments. Once deployed, they cut indiscriminately. And in a fragmented world, even your friends stop listening when survival is on the line. Japan is desperate, and for good reason. Over 80% of its energy is imported. For oil, the dependency is even more staggering, over 90%. This is a country with virtually no natural resources, but a colossal industrial machine to feed. And now that machine is slowing down. Since February, Japan's export growth has been fading. The first 20 days of May turned red. Exports dropped by 3%. That may not sound dramatic, but for an export-driven economy like Japan, it's a shock to the system. And the outlook for June? Bleaker still. Trump's steel tariffs are back. Over $1 billion worth of Japanese steel is now vulnerable. If those tariffs stick, even at a minimum level of 10%, Japan will be forced to rewrite its entire industrial strategy. It's not just about maintaining growth. It's about stopping the bleed. What options does Japan have left? Cut input costs. Fast! And energy is the first biggest lever. Because this isn't just about the United States. Japan is locked in a price war with China, a relentless competitor that has no problem undercutting the global market to win. Just last month, VOID, one of China's energy giants, slashed prices by 34%. That's not a one-off event. This is the third straight year of strategic discounting across China's industrial sector. It's a full-scale economic offensive. And Japan can't fight that kind of war with one hand tied behind its back. Their own energy subsidies are drying up. Domestic support is weakening. The political will to fund high-cost energy imports is evaporating. In that context, buying Russian oil stops being controversial. It becomes logical. It becomes essential. So what does this mean for the broader picture? It means Japan's not alone. Other nations will quietly follow. Russian energy isn't disappearing from the market. It's just finding new buyers. The idea that sanctions alone can crush Putin's revenues is already proving hollow. And don't count on the price cap to do the job. It's a paper wall against a geopolitical flood. This is the new global order. Fragmented, volatile, driven by necessity, not ideology. Every nation is now playing Hunger Games geopolitics. The alliances of yesterday? They're transactional. The rules? Rewritten daily. In this chaos, Japan has chosen survival. The question now is who's next? Will BRICS double down and issue a wave of new RMB bonds to sidestep Western financial systems entirely? Will other U.S. allies quietly do what Japan has done? Strike silent deals with Moscow while publicly towing the Western line? The pieces are moving fast. The world is tilting. And the idea of a rules-based global order? That might just be a relic of the past. Let me know what you think. Will Japan go all in on Russian oil? Will the West tighten the screws or quietly look the other way? Drop your thoughts in the comments. Stay sharp. Stay informed. We're heading into a storm and no one's steering.